Welcome again to the Cannabis Investing Podcast, where we speak with C-level executives, analysts, and sector experts to provide actionable investment insight and the context with which to understand the burgeoning cannabis industry. I'm your host, Rena Sherbel. Hi again, everybody. Welcome back to the show. Thanks for coming at us, with us, for us a day later. Excited to have you listening along with us as always. Super happy to bring back Mike Regan and Colin Ferrian, who have come on before. They used to work together at MJ Research Co. Now Colin is at Poseidon, and they catch us up today on the public and private markets in cannabis, how to look at cannabis, what we should be thinking about as investors in terms of metrics we should be using, in terms of valuations, some pro tips that they give us, ways that we can glean more unbiased insight into the industry, a great take on California, and towards the end of the episode, listen for Colin to turn the tables around and ask me some questions, and we end up getting into some nice cannabis roundtable discussions that I really greatly enjoyed. Always fun talking to Mike and Colin. Hope you guys agree. Talk to everyone soon. So Mike and Colin, welcome back to the show. It's great to have you both on. I'm interested to hear where you're both at. I feel like when I talk to you guys, and Mike, when I started talking to you until now, and I've talked to you both together, news each time I talk to you, and that's a fun adventure that we like to be a part of. So whoever wants to go first, I'm happy to hear like what you have going on and catch listeners up with where you're coming at from the industry.
That's a good point. I hadn't realized. First I talked to you was at MJ Biz Daily. Then I was second time was with Colin last year at MJ Research Co. And third time now I'm still at MJ Research Co. working on some additional changes that'll sort of enhance the research and hopefully enhance the capital availability of the industry. And Colin has had some changes as well, but we're still friends and happy to chat with you together. So I can let Colin chat about those.
Absolutely. Thank you, Rena. I am now at Poseidon Investment Management with Emily and Morgan Paxia and Patrick Ray, as well as Andres Navia on the private markets team. So excited to dig into some of those trends today.
That's awesome. And for those of us following, or for those of you following along, we had Emily on our California deep dive episode, and we had Morgan and Noah Hammond from Advisor Shares on CEO interviews. So if you want to know more about what Poseidon is doing in the industry, those are two great places to start. After, of course, getting all the lowdown from Colin. Or before, stop and go. I don't know. I don't want to cite your date for you. But in any event, there's lots of good stuff to hear. So before we hit record, Mike asked me how my viewpoint has changed or how my thoughts have changed surrounding the cannabis industry since I started the podcast 3 years ago. And so I was going to ask him to answer, but let's make that the first question of the show. How has both of your narratives, viewpoints, perceptions changed or evolved or devolved, as the case may be, since you got started in the industry? And maybe if you want to just give like a quick rundown of what you've done in the industry, just so we're kind of more informed about where you're coming from.
Sure. I guess, so just backing up, my background is basically, 20 years of long, short equity analysis on, basically all the sectors that cannabis is: consumer, tech, telecom, energy, extraction, industrials, things like that. And I joined 3 years ago following cannabis because I saw those similar business models. And I think there are two things that have sort of changed over time. One, and this is thanks to Colin and our work together last year, was really appreciating sort of the complexity of the plant itself. Like I think this misconception is, I think cannabis is easy to grow and very difficult to grow well. You're like, oh, it's a weed, it's easy. It's like, yeah, it's easy to get put a seed in the pot and have it sprout, but like it's more like, but getting consistent product produced at scale is not easy. It's very, very difficult. And then the second part is in terms of the analysis of the sector. I've been struck by sort of the diverse, not really diverse, more the spread of sort of the quality and thought processes and analysis that I've seen following this industry. it doesn't actually correlate with institutions versus retail. I've seen some very sophisticated and intelligent, thoughtful retail. I've seen less so on the institutional side. I've seen the complete inverse where it's not very thoughtful retail and incredibly thoughtful institutions. So it's not a function of your assets under management, but I've seen a lot of some very, very thoughtful analysis about what this industry really is. And Colin will probably talk more about some of the misunderstandings we see in the industry, but I've also seen some very, very shoddy low quality analysis, even by professionals as well as retail.
Can you give us a small example just for color on each, like some shoddy analysis, maybe on the institutional side? And, I feel like retail investors get some trash talk their way, and it'd be nice to shout out how they're kind of faring better than the institutional side.
I guess one simple example is, I guess anonymized is, I saw one publicly published report from a bank that forgot about 20 to 25% of the shares outstanding for a company, because those shares were technically not shares, they're founders units, but they convert at 1-to-1 into publicly traded shares. And the founders have been converting and selling those shares. So when you're doing your valuation on the company, you need to include those shares, even though they're not technically shares, they effectively are. It's just something like that. And then if you're, simplistically, your stock price, the target price or your valuation is now 25% too high because you forgot 25% of the company existed. That was one that was surprising. I've seen other analyses that forget 280E taxes entirely. They just do normal taxes that deduct SG&A and interest expense. I've seen others that just calculate 280E wrong, again, deducting interest expense, like interest expense is not deductible under 280E taxes. So that whole concept. And then at a higher level, we can talk more into this, but sort of how do you, if you're valuing pre-tax, but the tax is not tax deductible for debt, is EBITDA truly a useful metric? While 280E still exists, and we can get into sort of more of the theory of how long it will exist. Does it go away and then it becomes more of a normal company? But sort of that's some of the things I've tried to do it differently, and I've seen a lot of things that sort of throw numbers around and miss those nuances behind those numbers. And then in terms of the quality, more just it comes back to sort of basic due diligence of knowing what's going on in the industry, and taking what a public company says, but also doing due diligence with other operators in the business, private operators, understanding what's really going on sort of at a ground level. There's plenty of smaller retail people that either in the industry or they're actively analyzing that, but they're saying like, well, I know this company said this on their call, but I talked to 4 growers in California and they're seeing something different. that type of thing. And then real quick on the operators, I've also been struck how, there's, in talking with some private operators, how, there's also, this business can be run very differently. I've seen some private operators that are running differently than some of the public ones, and they're doing extremely well. And there are plenty of public ones that are doing well, but if you run this business right, even in competitive markets, you can generate very good solid margins, and it can be a great business. It's not just what you're seeing in public filings.
So some context, I came from, my career started in traditional finance. I worked for a long short fund here in Boulder, Colorado. And then back in 2015, I believe, we started investing on behalf of the partner capital into cannabis operations. And so I remember the first one that we saw was a company called M. Hardin, which is now, I believe, in receivership, or at least it's close if it's not. But at the time, they were one of the leading cannabis startups. They were growing in a storage locker here in North Boulder. Actually, I think 3 storage lockers. They had distributed cultivations and they were selling product into the grows. So I since after that transitioned into operations, working for companies like Urban Grow. I started a startup called Deep Green, where we were just scouting plants and trying to create computer vision out of that. And then with Mike back into finance roles, and now with Poseidon. And I think that my thesis has probably changed in the sense of I was a little bit naive coming into the industry, thinking that that capital would flow to the most efficient operators consistently. And that has been far from the case. I think that there's a hyper nuanced answer as to why that is. It was probably a mix of a lot of people that are investing in the industry are not completely or not very empathetic to the operations and product that these companies are creating, which is a little bit unique when compared to most other industries. You generally have specialists that spend all their time, especially further upstream in the capital side, so like venture to late stage growth. But that has not been the case, as mentioned, and so I think it's been interesting to see some of these companies where based on certain things you're seeing in the industry, things you hear from operators, that their product or service does not add a bunch of value, yet they're so much better at raising capital than they are running a company that they end up being successful, at least for a certain period of time in the market. And it's something for a long time in cannabis where I just thought that there's probably not enough capital to make that happen, where the folks that are good at fundraising, it's kind of like this tech dynamic of being good at fundraising, but you don't have to be good at running a company. That hasn't been the case to date, at least through the most recent cycle. Although, and I think we're going to dive into this later in the conversation, that is starting to change in a big way as capital becomes harder to find. It ends up flowing to the best operators. So we can run through that.
Well, yeah, go ahead. Take that as your own segue.
Yeah, sure. That's where we'll start then. On the private side, the key takeaways are that capital is disappearing quickly, and there are challenges and opportunities to this. So I'll give some context behind each of these points, but just in summary, capital is hard to find in cannabis right now. The challenges are generally that it makes it harder for anyone to raise, and there ends up being a shakeout of operators. The opportunity is that the stronger companies survive, and they generally have the ability to recruit more talent. They can innovate on business models more easily, et cetera. But this has generally been a product in the private markets of for a long time, the investors were providing capital to, just as mentioned, operators that are really good at raising capital, but not as good at running a cannabis company. And in cannabis, it's so dynamic that you have to have a team that's ultra empathetic to both the product as well as the consumer. If you're B2B, your consumer is the business that you're providing the service or product to, and B2C to the consumer. But so investors would allocate to these companies, and they would fund businesses that had unsustainable unit economics for a long time. And this is still kind of going on in the private market side, but you would see folks that have negative gross margins, or say that they're using all this capital to scale and doing tons and tons of, but burning tons and tons of cash. And those businesses that were previously overcapitalized and then sacrificing their unit economics are now really, really struggling because capital has disappeared, due to probably a longer conversation than we have for today, but public market trends and then all the way to cannabis legislation has caused those valuations to compress. You've covered it in all of the podcasts, for the past year. The opportunities from this is that the well-run companies that are actually good at running their companies and may not be as good at raising capital are getting a line of sight into the capital allocators much more quickly and easily. So competition will be on a much flatter playing field. We generally call them like the folks that are in here for just the trade, whether they be investors or operators, might be the tourists of our industry, whereas the locals, if you will, are going to have a much easier time in this cycle as capital goes out than they would have when people were investing in companies at 50 times revenues or something like that for what is largely a manual service in some cases. So it's also driving innovation in the supply chain, which has been super interesting from the private market view. So as capital decreases, people find a way. Cannabis finds a way. We were talking about this before the call started. But this is something that we say often, like internally at Poseidon, is that, if there's a hurdle, cannabis generally finds a way to, get around it. If there's, no access to banking, people figure out how to get access to banking. If there's competing with the illicit market, the legacy market is too difficult because they have delivery and live ordering, et cetera. Cannabis finds a way. Those are created. So some of the most interesting ones that we're seeing right now would be the direct-to-consumer businesses, and this is most prominent in California right now with Amidst, Ginger, and Grass Store. But what these companies do basically is, if you're a consumer, you can order a brand directly off their website, and it gets delivered to you through an existing delivery service. So on one side, you're helping brands gain margin, which allows them a much easier path to survival. You help delivery companies ensure capacity in their businesses, which is easier for them to survive. And there's tons of opportunity for this business outside of California right now. So that's one of my favorite ones. There's a bunch of banking innovation from, really some of the largest tech companies in the world, all the way down to the cannabis specific businesses. And a lot of them are actually going to market right now because we don't see any potential movement in or meaningful, likely movement in legislation. And then I would say the last one on the innovation that's helping these businesses do better, especially the strong operators, would be automation. So this goes all the way from like cultivation and MIPs, so manufacturing processors. In cultivations, you're seeing computer vision from folks like Ataviv that are completely automating the scouting process, which might take a single person an entire day. A computer can do it in a few minutes. Sorting robotics is helping manufacturers streamline their operation process by making it easier to create products. And then all the way up to retail, where you're seeing inventory management systems that are actually paired with your POS and delivery, so you don't have that problem of ordering off a live menu, getting to the store and the product not actually being there. So those are some of the high level private trends. I kind of ripped through them, but.
So Mike, talk to us about the public side of things. Do you concur with what Colin is saying about capital and how you're looking at kind of quality management teams? Or are you looking at the same kind of trends?
I have also, in some ways been struck by the whole sector trading together as if it's just a single monolithic trade and not having as much differentiation amongst the specifics of the operations or the management teams or the balance sheets or where they're operating. So that's been something that's been a little frustrating, from an alpha standpoint, or just from this company is better, it should get more capital. This company is clearly not, the product doesn't work and the balance sheet's screwed up and the management team doesn't seem very good. Why are they getting any capital? Having those things. I guess one thing Colin did say that he threw out was some of the valuations. One thing I guess to point out, especially as we'll stepping back, I guess one thing that maybe it's the investor base or just the nature of speculation and going into high risk is cannabis seems to sometimes get lumped in with tech. And even I made the analogy of this feels like sort of internet 99 to 2003, long-term macro thesis is pretty obvious to everybody, but so there's some operators that, probably raise capital that won't exist, but there will be ones that actually continue this whole, that will succeed, right? There's going to be plenty of pets.com's advantage, but then there will be an Amazon that does well. To clarify that, that's not that these are tech businesses. These are, consumer, industrial, and agricultural businesses, which they're very different. It has a secular growth trend, but the key thing to remember is that there is seasonality in consumer businesses and in agriculture, and there's also, I think, there's also secular trends within it as well. There's cyclical trends amidst the secular growth, right? Even if it's not just straight up and to the right, it may be up, then it comes down again, but then it goes up to a higher level, then down again. That's just the nature of agriculture, of things where you have your main product is essentially a commodity that is subject to supply and demand increases, the price goes up, supply comes online, the price goes back down, and people need to remember that. And then even within the year, there's different consumption patterns throughout the year. No one's surprised when Toys R Us sells or used to sell fewer toys in January than they did in December, or that they're selling more in December than they did in July. It's the same concept. So that's one thing I think maybe within the investor base needs to change over from investors that are just thinking like, oh, this is like tech and it's speculative. I'm just going to plow into and step back and say, no, this is, what am I buying here? I'm buying a consumer product that will have greater consumption as states legalize and the product becomes more normalized and gains more general consumption within the population. And as an existing market from the unlicensed market can get converted over to the legal market, which frankly will also take lower prices. That's what some people I think sometimes forget is, the easiest way to convert consumers from the unlicensed market to the licensed market is lower prices of the core product. I've been doing some analyses on elasticity and sort of because when you see things like, oh, Colorado sales are dropping, well, remember there's the dollars where if the price is down 30, 40, 50%, of course the sales are probably going to drop unless you have one-to-one elasticity, but you can still see the consumption actually still rising over on a general trend. I think that's more important for, if you're looking out more like 10 years at least in the US, what happens to consumption patterns as price goes down, more of the illicit market gets converted. With legality, more consumers that would never, buy something from they would find and buy something at a store, but wouldn't know a guy, they're not going to bother trying to find the guy they know, but if it goes into a nice store that, is next to the Target, they'll go purchase something. One interesting thing just for historical context was from alcohol prohibition, just the 10, 15 years that alcohol was prohibited, the consumption dropped 70% in the country. And it didn't actually rebound until 1975. But we're sort of in that bottom period of, cannabis has been prohibited for, it's been Schedule 1 for, over 50 years and in some form of control for, more like 100. What would, we're at that bottom level of, when prohibition ended, it was already 70% lower than it was 20 years earlier. As you then start to legalize and normalize, you have that whole potential growth projection ahead of it, who would consume if it wasn't illegal, if it was easier, it was lower priced, and what have you. Another thing that also on the public valuations, a difference I think that people need to remember versus tech, especially in the last year or so, was while the valuations were high and they've clearly come down in cannabis, they were never truly irrationally insane, if you will. Even at the very peak on February 10th, 2021, which that's what we have as the actual peak, the average for the US operators was 29 times EBITDA. And consumer names that are working, that are growing fast and having high margins and everything, like Chipotle and Lululemon and St. Adams, they have easily achieved 20 to 35 times EBITDA. Even the lithium producers, Albemarle and Livent, that's literally a true commodity. You go in the Andes Mountains, you punch a hole in the ground, salty water comes up, you evaporate the water, you're left with lithium, and you make a battery out of it. They trade at 25 times EBITDA sort of at the peak. So it's not like some of the more speculative tech names like Datadog getting to 45 times sales and 300 times EBITDA. They were highly valued, but not sort of completely insane. Be oh, well, they're like Chipotle, that's reasonable, right? At this point, I guess there's a lot of time valuation. The valuations have come in a lot. At this point, I've gotten about 12 times 2022 EBITDA. Then we go back to the tax issue. The problem with EBITDA is it's pre-tax, and cannabis basically has to pay taxes on gross profit. And the tax regime is significantly different. So as long as that's in place, you really want to look at it, what I call sort of EBITDA, like earnings before interest, depreciation, and amortization. Because ultimately, you'd rather look at it on earnings, but as I said before, I've seen, at least using consensus numbers, I think the sell side gets the EBITDA more accurate than their earnings. So I've seen too many questions on taxes and interest and all that. So my cludge is basically to take the tax, take the the 25% of gross profit, take that off EBITDA, and you're left with EBITDA, and then do the same thing of take EBITDA less taxes, even though it doesn't really make accounting sense. It does from a theoretical sense if you're trying to compare it to like a Sam Adams, right? Like what if Sam Adams had to pay their taxes out of gross profit to get that sort of EBITDA? And at this point, actually, the cannabis guys, the US ones, it varies a lot, but on average, they're actually cheaper than the alcohol names at this point. And that basically ignores that first, they should be having faster growth. There's secondarily a cannibalization question of is alcohol going to get cannibalized? That's up for debate, but that risk is less there. They're the cannibalizers, not the cannibalizee. And you still have the concept that 280E may go away at some point, right? If you're using this EBITDA analysis, that basically assumes 280E is here forever in perpetuity. You're capitalizing it forever, right? So, if they're at 18 times, the EBITDA, like EBITDA minus taxes, if 280E goes away anytime in the next 18 years, then that actually is a positive catalyst at some point. So that's sort of, I'm starting to look at that, at least in the public side, they're getting lower, the valuations are getting lower. Then there's questions how much high quality are the estimates. That's why I'm using 2022, because I think those are probably more dialed in, versus the longer term ones. That's sort of a long-winded answer on that, but.
No, I was gonna say, I mean, when you were talking about the crazy valuations, like these weren't crazy overvalued stocks, like at the peak. I'm thinking the crazy valuations are now, how undervalued they are. And that seems to be like the crazier sentiment based on, kind of the top operators, the top stocks. Yeah, because I feel like you hear so much like we're never going to get back to that time. We're never going to get back to that peak. And it's like, and something we've been talking a lot about on the podcast is the timeline of investing and what happens, to valuations along the path of what this cycle is, which is, a growth sector. Anything to add to that? Or Colin, do you want to say anything about kind of how you're viewing valuation?
No, I think Mike covered it on the public side. The private side definitely saw what I would describe as overvalued companies in many cases, just because you have this dynamic of everyone thinks that they're going to buy a cultivation or a retailer and then sell it to an MSO 8 months later for 4 times the money. And just because cannabis is popular from the sense of it's new and exciting, you tend to get investors on the private side that are a much different set of investors in the public markets. And those investors may not necessarily be as sophisticated. They may not have gone through market cycles, et cetera. And so they're not quite as efficient.
Talking. There it is.
I don't mean to there are just folks that want to be involved in cannabis from the investing side that may not be investors in their day jobs, right? And so they don't care about what the value, they don't care as much about what valuations might be. And it's an unfortunate dynamic in some cases. Of course, it can work out, but in some cases on this private market side, you tend to see situations where people will raise a friends and family round from their peers, like people that they have to eat Thanksgiving dinner or spend their holidays with, et cetera. And when they go to the institutional investors and find out that they raise way too high of a valuation and they have to do a flat or a down round, or that their likelihood of exit is much lower than they had expected, or at least the potential liquidity, the valuation at liquidity event, it makes for really difficult interactions with people that you're close with. So that's all to say that not necessarily to bash the other investors. I get that it's exciting. That's why I'm here as well. But there's also a sense of, what is the likelihood of this business going out and, is it going to exit for 15 times revenues, or will it be 1.5 or 2? That's a big difference when you're the seed capital of an emerging venture.
So what are you looking at in terms of when you're looking at a company that you think is going to succeed? Like, especially kind of based on what you were saying in terms of like the search for capital being different than kind of the next step after that in terms of growing and scaling an operation. What are some of the things that you feel like identify, or either like parts of, I mean, you mentioned a few things in the sector at large, but kind of how they operate within those kind of more exciting lanes that are coming up?
I mean, the first thing we look for is team. Cannabis is a people business at all levels. It doesn't matter if you're an MSO or you are a craft grower with 2,000 square feet of canopy. The business relies very heavily on how well the people can run their business, obviously, and then communicate and hire. And it's not completely different than like tech companies per se, but when we talk about how empathetic the team is to the operation is like a big piece of the underwriting. So ideally, if someone has a background in the operation that they're building, that helps quite a bit, because you can understand what their how successful they've been in the past and how many fire drills they've had to deal with. Because if you're starting a DTC company, if you're starting a new retailer, in cannabis, you are constantly dealing with things that you did not expect to have to deal with. There are going to be hiccups, there are going to be setbacks. You just have to know how to handle them. And so I'd say people is the absolute number one aspect of this. And we can probably get into more deeper on the MSO side, but sticking to the private markets, I'd say the next aspect of it is how empathetic are these operations leaders with their clients. And so if their client is a distributor, let's use a contrast to start. This comes back to people chasing shiny objects. We often see folks in cannabis, not often, but we can see folks in cannabis that want to start a business because they see it as an exciting opportunity, and they come from somewhere else and they have not done their due diligence on what consumers want, what businesses need, et cetera. They just say, this worked in another industry, I'm going to apply it here, and I'm going to go out and raise capital, and we're going to see a massive exit. Now, the cannabis industry is so fickle. There's constant nuance in between what consumers want, how the supply chain is going to change, what happens to policy, that you have to spend tons and tons of time understanding your end consumer. Again, whether you're selling into a cultivation or selling to an end customer, because by the time that you go to access your market, you might have the best product in the world, but you won't get traction if it's not the number one item that cannabis operator needs at that moment in time. There's too many other things going on for cannabis companies I'm saying on the ancillary side, but there's too many things going on for cannabis companies to take pitches from folks that are just slight value add products. And on the consumer side, it's the same way. We can use an example of celebrity brands, right? This sounds like a great idea. And there are a lot of people that followed celebrity brands because it's worked in other industries like smart water. There's plenty of CPG examples. But in cannabis, it's just been proven that people appreciate much more good, consistent product than they do testimony from somebody that's popular in the space or in any space. And so coming back to this, when we're underwriting, the people is most important. The empathy is second most important. And then from there, it's, the more standard items like underwriting the sustainability of the business model. Are they going to sacrifice a little bit of growth in order to keep the cash flow more reasonable? Because in cannabis, you probably need a rainy day fund as things go wrong no matter what. And that's probably the short list.
Yeah. I wanted to follow up on a few things that we talked about in our last conversation. I wanted to see where you guys are thinking about this. Colin, I know you might have slightly different answers, not focusing on the public markets now, but because I feel like, first of all, what intrigues me is we've talked a few times, and I feel this way about the podcast in general. Once I have repeat conversations, I'm struck by how similar themes come up, kind of month after month, year after year, that I think are going to be answered by the industry, by legislators, by regulators, by whatever. And they're not, and there's still questions that we're thinking about and talking about. Some of that we've talked about already, like with 280E and how the industry is building. And I think another thing that we talk a lot about on the podcast is, the behemoth that is California cannabis and everything that's going on there in terms of the players and how kind of they expected it to look, how it looks in reality, the legal and illegal markets, and kind of the power that the illicit side still carries there. I guess let's start there, like with the California. I was gonna connect it to the East Coast, but let's pick a lane and stay with it for a second and not muddle our messages. Kind of curious to where you guys, last time we talked, and we've talked a bit recently on the show about the parent company, but the parent company in Glass House, and then there's a bunch of, smaller players who are trying to, I think, make a name for themselves in the state and see where it gets them. What are your thoughts about the state and kind of the growth and the companies that you see competing out there?
I think that kind of goes back to first what Colin was saying. It's important in the public markets too, of basically trying to find good people, because in that dynamic industry, you're basically betting on who you want to manage your capital and allocate it smartly for things that no one has anticipated yet. In terms of California, you said you want to bring in the East Coast, but I think that's one thing everyone needs to remember, that even in the limited license states, because most of the public operators are in the limited license states, you're still competing against unlicensed stuff from California, right? So California catches a cold, it gets exported to the rest of the country. So that's always something to remember. And that kind of goes back to what I was saying earlier about just anticipating lower prices and maybe even lower margins. That's one thing when you look at a lot of the, at least the consensus estimates on some of the public operators, the margins are higher than in the more competitive markets, in part because they're in limited license markets. But at least as I'm trying to think about the industry for the next 10 years, I try to think of what is this. I think the industry, even in limited license, will look more like the ones in competitive markets, if only because there's the unlicensed market. Stuff's coming. If they're growing too much in California, there's someone that doesn't mind driving a couple days, then it's going to show up in Massachusetts, right? Just on the arbitrage. But the key thing to remember is that, a 25% margin on $1 billion of revenue is more than a 35% margin on $500 million of revenue, right? It goes back to the whole part about having lower prices and having a business that's lean enough to operate at, $1,500 or $2,000 a pound, and a business that doesn't need, $4,000 or $5,000 a pound to make money. But the second you hit $3,000, you're not sure if you're making payroll. That's kind of why I try to look more to the more mature markets that are more competitive, like in Colorado and California and Oregon, to see the margin structure there. And that's like some of those operators are some of that are doing very well. They're doing well even in California, even amidst some of the downturn. So it's, it's, at the end of the day, it's not rocket science. It's consistently grow a product at a price that is competitive and distribute it in an efficient enough way to keep some money for yourself and add value to the consumer. In terms of some of the public ones, this kind of also goes back to the whole, like you mentioned, this is a growth industry, but this goes back to, it's a growth industry. It's a secular growth industry of a cyclical business that also has seasonality. So it's understanding all those moving pieces, right? You can do this for 10 years. You can go straight up for 10 years, but it's not going to be straight. It'll be, prices drop as supply comes online in California, and we're actually still seeing, more supply. It's a question of whether some of that supply is going to shake out. Glass House's strategy is to be a low-cost producer, So they're adding supply into an oversupplied market, but their hope is their costs will be lower such that, the best way to think about it is if you've ever seen, like the oil industry has a lot of great charts of like which countries produce at which price, right? So it's a cumulative supply curve where, in the far left at like $3 a barrel is Saudi Arabia, and then, US fracking is in the middle, it's sort of $30 a barrel. And then, you go out to the far right at $100 a barrel is deep water drilling in the middle of the ocean. When oil goes from 100 to 50, that deep water rig is not getting drilled, but Saudi Arabia is still printing money at the low end, right? That's basically what Glass House is trying to do. So it's a function of, are they going to be able to do that and squeeze out those ones that are higher cost production? Their bet is basically producing at scale will lead to scale economies and have a lower cost per pound. Historically, the industry has not been scale production just because of the nature of the illicit market, and where a lot of growing techniques came from, is you're not worried about production, you're worried about not getting caught, right? So you're not going to have, it's kind of what the two professors were saying last week. You're not necessarily optimizing for lowest dollar per pound, you're optimizing for not having the DEA shut you down. Because I don't think anyone had like 1 million square feet in their basement, right? So that's what they're trying to do. We'll see. I think the jury's still out if they can do it. We've seen operators produce quality greenhouse cannabis at larger than illicit scale here in Colorado. That's more sort of 40,000 square feet. So the question is, can they do that at times 10? If it's basically 10 40,000 square foot units, then that's actually more believable than one giant unit, one giant greenhouse. So that's what I think they're, we'll see if they can do that. But in terms of that model though, you sort of need that lower pricing to sort of try to wash out the higher cost ones. That's actually when they'll truly thrive, is if they can get their costs down and then gain the share from the higher costing producers. And that's why if California actually eliminates that cultivation tax, simplistically you say, oh, that's, multiply the $150 a pound for a cultivator times the number of pounds produced, that's how much you keep. Yes, but what you'll probably do is you'll probably put that back into lower pricing. But then the positive of that is then gaining share from the illicit market. So you actually sell what you've got sitting there. Because that's the other thing to keep in mind with any agricultural product is, you can have 10,000 pounds of cannabis, but if no one's buying it, it's worthless. It's just sitting there getting, you already spent the money to grow it, and now it's just getting worth less and less and depreciating every minute you're not selling it. You have to move it, right? In terms of even California, we heard someone say that there was a farm that was selling for $50 a pound, obviously illicitly, just to make payroll for the next week. Because, hey, I've got people farming and I can't make payroll, and I've got a bunch of weed sitting here I can't pay them in weed. So fine, here, take it. Obviously that stuff probably then gets driven, a couple thousand miles and sold in the high cost state at a very low price. So that's a very long-winded, little bit of rambling answer, but that's sort of my thoughts on that. I don't know, Colin,
Yeah,
if you have any other
that's
thoughts.
good, Mike. I think a couple good points in there. So cultivation historically has not shown economies of scale. Now, this is something that we've gone back and forth on, just us two personally, for a long time, and trying to figure out how we hash this out. But generally, think about cultivation for a long time, as Mike had mentioned, had only been limited to a certain size for various reasons. And now you see more and more of these cultivations growing bigger. The catch is that you do get economies of scale on areas like consumables, whether it be nutrients or medium or your Tyvek suits, et cetera. But ultimately, where your biggest costs lie, generally with labor, that only scales to a certain point, right? There's only so many cultivation techs that can cover 25 or 50,000 square feet until you have to duplicate them. And so at that point, is your 500 square foot grow, 500,000 square foot grow as efficient as 100,000 or 50? That's probably a good question that isn't getting asked nearly enough. Taxes helping sales volume, not margin. Another great point from Mike there. I would just add on here on the California side and generally how I look at it. First, I would say the bottom is probably not in, and I would just caution folks from looking at being maybe misled by a dead cat bounce of crop prices coming up from Croptober and thinking about that as they're up quarter over quarter, but where are they at year over year, right? This is still a cyclical industry. And so in any Q1, you're going to see those prices up. But if they're still down year over year, it implies that supply is still coming on and that the bottom in pricing is not quite baked in. That said, I would also mention, as Mike noted, there are a bunch of businesses that are doing super well, whether they be craft cultivators, retailers. Generally, retailers are tending to serve heavy user buyers. And then folks like the more innovative supply chain businesses like the DTC. I don't know if I won't call a bottom or try and guess when it is. A great shortcut for investors that are looking for a way to stay up on the actual transparent trends in California. Listen to the Scott's Miracle-Gro conference call every quarter. Jim Hagedorn will not lie to you about where crop prices are because he doesn't have to. And it's the easiest way to get a sense of where they are without hearing somebody trying to spin a narrative around why the prices are where they are. The Scott's Miracle-Gro call, you'll hear exactly, we expected things to come back in second half. They haven't come back. We see no end in sight, et cetera. But also be cognizant of when you're in the cannabis industry and looking at prices in general, like you are competing against a lot of people that are much more passionate about their job than they are passionate about making a ton of money. And when you're competing with those types of folks, you can't expect margins are going to snap back in a moment because there's some type of shakeout. These people they will last much longer than you might expect them to. And in all likelihood, they may just emerge to be the leaders because they're the folks that are happy just scraping the bottom of the bucket, surviving out in the market. So those are what
I was going to say, do you think you both mentioned listening to the podcast last week where we were talking about legal weed and kind of the path towards that and the illicit market. Are you, and something we talked about there was kind of the place that craft growers have in the industry and how there's kind of like a special niche that those growers can have. A, do you agree with that? And B, what's your, I mean, I hear the take and the correlation with Glasshouse. What's your take on kind of like the parent company's approach, which is scaling and coalescing a number of different purveyors, but kind of capitalizing on more the DTC, the direct to consumer that you were mentioning. I'm interested to hear both your takes on the craft approach and kind of your place that you see it in the industry, the viability of it long term, vis-a-vis kind of like more price conscious cannabis, and then kind of the scalability of the parent company and your thoughts on that vision or that company, however you want to take it.
I can kick off on the all right. So the craft grower approach, it is that also that was a fantastic episode last week. So for those that didn't listen, I highly recommend it. It is very thoughtful. And it was very thoughtful. I'm looking forward to reading the book. So there's that. But on the craft approach, it is probably the best cultivation model that we have that is in the market right now. You've seen a couple of companies make great brands out of craft cultivation, and they have garnered really committed consumer bases. And that's all over the country, not just California. Colorado, we have them here too, where there's certain folks that will, they run a 5,000 square foot canopy grow and they do drops, and people pay up, including me, for that flower. And they make 30% EBITDA margins out of those businesses. Long term on the value driven aspect of it. So like the other side of this is not a place where I'd ever want to compete. And so I'll work this back to the bigger grows, but on the value driven aspect, we are seeing price erosion in a massive way in the bigger markets. So take California, for example. You can go online and find, whereas edibles, I think would have been don't quote me on this necessarily, but let's call it the $20 range a year or two ago. You can find edibles for $5 right now, and that's all just because biomass has become more affordable. MIPS have become more efficient. So if you're somewhere in between and you have a super large grow, you have to execute on at least creating at the bare minimum, it has to be a consistent quality product that may not necessarily compete with premium indoor, but it has to be much, much better than what's available on the outdoor side. Because say like in a greenhouse driven business, you have way more overhead than the outdoor and a little bit less than indoor. And a lot of folks talk about how it's significantly more efficient, and that will be the case in the future. But the unfortunate reality is that 80% of greenhouses in the market today are filled with mini splits. They've got inefficient structures, and they don't have that much less overhead. You're fighting humidity from the sun by boosting up your AC and running dehues 24 hours a day. So I would just make a note of that. And then on the parent company approach, and maybe I'll let Mike dig into it a little more because I have not been watching the updates. The original model was a great idea. However, the business model in general is a great idea. Leveraging brands and bringing them in to create this incremental margin story, which is not that much different than what you see in traditional CPG. The catch of what they did was, frankly, overpromised on estimates in a huge way, and then massively diluted the cap table through the SPAC. And we did a ton of work on this even before they went out to market. But even today, I believe that there's still a bunch of shares that get unlocked on an annual basis that requires a ton of cleanup. That said, shifting around the management team, especially folks that are going to be a little bit more empathetic towards a CPG and cannabis-driven consumer, I think is a great change and provides light at the end of the tunnel for a company that's had that's struggled otherwise.
Yes. On the parent company, I would say that Colin summed up a good strategy within contracts that have continued additional dilution, and as it can get into a vicious cycle as the stock price goes down. They basically have contracts that promise fixed dollar amounts payable in shares. So as the stock goes down, you issue more shares to pay those contracts, right? Like $1 million. If you owe someone $1 million at $10 a share, right? It's only 100,000 shares. If it's $1 a share, then you owe them 1 million shares, right? Like that's the way the math can work. But like Colin said, they have a solid balance sheet with the cash. Obviously they're burning it, but if hopefully they've guided how much they're going to burn this year, and we'll see if they burn any more. But basically a solid balance sheet and a new management team coming in. Troy Datcher coming in over from Clorox. We'll see how he sort of changes things to implement what we always originally viewed as a pretty interesting strategy. And then it just has the added complication of doing it against a difficult macro backdrop of the still continued price pressure in California. Even if it is stabilizing, that goes back to the whole what is secular, what is cyclical, and what is seasonal question of we can have a 10-year growth trend, but we can have a year-over-year cyclical price decline, and we can have a seasonal price uptick as we go from October to January to March, understanding where you are in all of those. But I have also, but back on the California question, like Colin said, there are operators that can do well if they're managed well. So we'll just have to see if some of these operators who are publicly traded can operate like that. We also, Colin also mentioned the people, Graham Farrar, who's in charge of the cultivation over at Glass House. I've spoken with him. He seems like a pretty intelligent guy who's, some of this stuff isn't built yet because they haven't figured it out. So the question of whether we'll be able to scale, we'll see, but he's going to try to make it scale. In some ways, it sort of looks like to me, it's the early days of building cars. They used to be, the 1900 Cadillac was hand built and only for the incredibly wealthy. And then it took Henry Ford to make a car, with mass production that anyone could afford, that had, much lower costs and a much larger volume, right? So that's basically what they're trying to do. We'll see if they can I don't know how to do it. If I did, I'd be out there with Graham doing it. But we'll see if he can figure it out, or if he can, maybe someone can, or maybe inherently there aren't economies of scale. That jury is still out on all that. But that's, I think, what sort of makes this a more interesting and exciting business. Back on the craft versus volume question, this also comes back to a function of scale, right? Individually, a craft business is great because you have essentially pricing power, right? That's ultimately what your craft is, your brand that lets you charge more for, what sort of is similar thing, right? Generally, especially in agriculture, the costs are similar to grow high quality product versus lower quality product. So if you can grow higher quality product and then produce it in a similar, at the similar cost, then you can do pretty well with that. But the volume will still remain more in the lower priced volume category, right? That's where you look from a dollar standpoint. Yes, this individual grower has great margins and is doing very well on their own, but that goes back to yes, the Cadillac probably made more money than the Model T, but there's a lot more Model Ts sold, right? In terms of the volume game, right? There's a lot more Budweiser sold than Dom Perignon, that kind of question. So, that volume business will always exist, and that's where most of the dollars will be, and that's where then lower costs and distribution come into play, right? Look at most of that business model is basically producing or sourcing at a low cost and distributing at a low cost, and then having economies of scale on marketing. That's the traditional. That's why Budweiser is Budweiser versus just me brewing beer in my basement, right? So those are evolving, but that's one thing that investors should remember. That's what I was saying back before. In terms of the investor bases in some of these stocks, that they were all growth investors that are just looking for, Colin saying, if we invest in even a private company, are we going to get our exit by just selling it at 15 times in the future? You might need the investor base to transfer over from, someone who's just like, okay, I'm going to own this for a couple of years and then exit at a sale where most of your return comes from the sale, versus I'm going to invest in this capital intensive secular growth but cyclical business where I'm going to focus on low costs and building the infrastructure, because I see out in 10 years that there's going to be this large volume and this large cash generation business once we're at scale, but we're building it in the meantime, shifting the investor base to people that understand that concept more than just buy something, grow the revenue really quickly, and then sell it at a high multiple.
This is probably a good point to expand on here, is that there's a strong thesis that value-driven growers will be able to, with the right technology and people, create premium products within their facilities. It's completely believable and rational. It just hasn't been proven quite yet. So whoever is the first to prove it will be wildly successful in the industry. But it's worth noting and kind of discounting expectations as those businesses do emerge that we haven't seen anyone do it quite yet.
I'm curious, just because of where you're coming from, Colin, are you seeing, I guess, quality candidates come for that?
At scale?
Yeah.
Yeah. There, frankly, in California, actually, there are some growers that are growing. Mike cited folks in Denver. Lightshade grows in a greenhouse and does, I think it's 50,000 square feet or so. And they have really high quality. In California, there are a couple growers that are at that low 6-digit range that are doing really great jobs. It requires years of tuning and figuring out your SOPs, though. It does not happen within your first 2 years. It doesn't matter how great the infrastructure is. It's like learning a myriad of complex systems over that period of time. There's bound to be hiccups. And so once you kind of learn how the cultivation, I'm trying to think of like the best analogy. I can only think of playing a guitar because you kind of learn like the nuts and bolts about the instrument, but there's probably a better one. At any rate, there are folks that are doing it really well. And so that has largely though been in indoor. There are a couple of, indoor and a handful of greenhouse growers, but not at any scale that would be considered like a value-driven approach, which I think that's probably like 500,000 square feet and over.
Mhm.
And I guess to be fair, also fair to Glass House, part of their strategy is low cost production, but their strategy is really also vertically integrating so they can capture essentially the distributor margin, right? Like right now they're more wholesale, where they grow, but then they sell it to someone who then sells it to a dispensary and they capture that margin and they get that, Glass House doesn't get that margin, the distributor does. As they keep buying their own dispensaries, they can capture that full margin impact. So they grow it for whatever they grow it for, and then they sell it for the full retail price in their own vertical integration. That's the other part of that story. Specifically, I think sometimes people may miss is that, that's the other economy of scale in general consumer businesses is distribution and branding, right? So if they can have their own brands in their own stores, they're in that same thing of like, hey, we got a lot of product here. It's not going to sell itself, right? And if we don't sell it, it's just sitting there rotting, right? So it's moving it. Having your own dispensaries can move that at a higher margin than if you go through a distributor. It all comes down to what's the scale. The distributor presumably has more. You can either sell in bulk and let them capture the margin, or you can sell through your own channels. If you can sell essentially in bulk to your own channel and then capture both margins, then that's a margin uptick on essentially doing the same thing of getting that product from your greenhouse to the consumer.
And it's a great opportunity for both Glass House and Parent Co. right now, is that people are so afraid to invest in California that you're finding screaming deals on valuations for most of these operators. And it's obviously not easy because if your stock price is massively depressed, it becomes that much more expensive to go out and buy businesses with equity. And if it's hard to raise cash, and being a California operator makes it even tougher. But kind of talking about the upside of these theses, it would definitely be the ability to go out and be greedy while others are fearful.
Like any great investor should be.
Like any great investor.
Well, I have more things to ask, but I don't want to take up too much time. And they're not just insightful, but they're also fun guests. And Colin wants to turn the tables and ask me some questions. Well, I don't know. I'm assuming that
that's okay.
Colin.
Rita.
I don't know if you guys talked about this together. I don't mean to leave you out, Mike. I don't know if it was a.
No, it was Colin's idea to turn the tables, but I'm a full supporter of it. I think it's a great idea.
It's a team effort. So if you're all right, Rena, the context here is that you get asked questions occasionally on the podcast, and they're always really great answers. And so we thought we'd put a few down and educate the listeners as well as ourselves on the show. So first one would be, what are your most insightful learnings from the podcast in recent memory? I hate to put like a time frame on, doesn't have to be all time, but what comes to mind?
Yeah, it's a question that it makes me think about all the like interesting, insightful conversations and people that I've talked to, because it's like I feel like I could pick from a number of them. But I think honestly, what gives me the most hope and inspiration is more from, and kind of, I think, meaning behind doing this podcast, is hearing people's, and this may come across as trite, but I mean it in the deepest sense, but how people have navigated their places within the industry, whether it's having like bad employer after bad employer and still plugging away at trying to find the right place, whether it's not being in the right lane of the industry, whether it's not being in the right outfit or firm. I find that really inspiring and reflective, because I think, and I feel like this is a lot of what was talked about today, is, you want quality people and things associated with this plant that has so much quality to it, has so much benefits. And I think to have the crappier side of things come out feels like even worse in this industry. So yeah, I find it really recharging and encouraging to talk to people that are just like plugging away and persevering and making better from where they started.
I like that. A few come to mind from the recent episodes,
Yeah,
but
same,
I'll leave those
same.
out.
That's why I didn't want to single anyone out. Sorry,
Yeah.
but there's so many.
But there have been some, great examples
Yeah.
of that on the podcast. What is your most contrarian view about the cannabis industry?
So like my own like one that I hold.
Yeah, like what you think is most contrarian relative to what you believe is consensus.
Yeah. It's a good question and has made me think that I'm not very contrarian. I feel like, sometimes I'm reminded that middle of the road and average is because most people share that. So I'm like, oh, everyone thinks this. Oh, I don't know that I necessarily have a contrarian opinion, other than I guess maybe I would say I don't think I'm like rose-colored glasses optimistic. And I don't think I'm brown-colored pessimistic. So I think if you fall on either one of those, I'm probably a little contrarian because I see the timeline going a bit longer. I see it being more protracted. I see a lot of trickery in the machinations until we get to that clear, wide open space. So I would say at the most, I'm contrarian, maybe according to a bit of an extremist, but generally subscribe to pretty middle of the road theses.
That's good. I'm tempted to ask Mike his.
If
maybe
Mike
we'll come back to the round table.
ask him.
Go ahead, Mike.
About most contrarian. I think the most contrarian point or view that I have is I would lean more towards operations in the more competitive states that lower margins but are more reliable than I'd rather if you're looking at investing, it's a lot of the margins of the public ones are high, and I wonder if how are they going to change as their markets become more competitive over time. It's great to make high margins, make it as high as you can and grab it while you can, but try to keep in the back of your mind how sustainable are those margins. And honestly, I do think the industry probably benefits from, it's probably a better industry at a lower consistent margin on a larger base, larger revenue base and lower margin, I think is a stronger investing case than, higher margin on a smaller revenue base, right? Selling more at $2,000 a pound and maybe 25% margins like the competitive markets, I think is probably longer term a better investing case if you're underwriting longer term than having $5,000 a pound and 35% margins in a limited license state only, because I view that ultimately is probably temporary. If they can keep it up, that's great, but that's something that I'm a little more contrarian on, I think.
Like that.
Maybe I'm looking way too far out, long run, we're all dead. So,
But easier to underwrite. No, I think that's a great point. And who knows where, in any given market, right? Take New Jersey, for example, the legislators have forecasted, the intent of keeping supply up with consumer demand. People have completely differing views on how that will shake out. But, if you're underwriting an operation in that state, your bear case is that it becomes highly competitive because that's what the legislators have said. And your bull case is that this is what they're conveying to the people, but in reality, they would rather, they're being lobbied by these firms and they would rather keep it ultra limited. So that's much tougher to underwrite than Oregon. Oregon's not going to change meaningfully probably over the next 5 years. Then let's see, Rena, what aspect of the industry would you like to learn the most about? What's like the most interest you right now?
Definitely the science side of it, which is kind of the hardest part for me to retain. So I feel like I need to learn things like 2 to 3 times before I actually learn them. But yeah, just knowing more about like the science and the biology aspects of cannabis and all the things that they're uncovering and what it all means and how the terpenes affect us and different cannabinoids and what they can do. It's just like, I think like every cliche about being at the start, the beginning of of a journey in the first inning, the start of a trade. Like, I feel like we're just touching the surface of understanding cannabis. So I feel like that's really exciting and feels like infinite how much you can learn about that.
Awesome. Mike?
It's something I've been doing. I'm trying to do more of is just keep talking to people in the, private operators, to get both sides of the coin of what's actually going on in all these different markets. You just keep trying to, which just goes back to due diligence 101, right? Just sort of on the ground gumshoe research of just talking to lots of private companies and in the whole sector to try to understand what's going on in a given market,
Yeah, I like that. I'd probably double down on the science aspect of it because it's been tough to parse through, especially over the years, of like what science is most important to the industry, like what's going to actually change consumer trends versus what is way out in the distance, kind of synthetic cannabinoids versus, stuff that's more simple, like just improvements in extraction systems.
Mm-hmm.
This is going to be, we'll do for Rena again. How is your relationship with the plant changed since starting the podcast? I think it was late 2018 or 2019.
2019, yeah.
Yep.
Early 2019. Yeah, I think honestly, it's one of the things that I most love about doing the podcast is I feel like exposure about what cannabis is. Like, even working in Seeking Alpha, when I first started the podcast, there were like, we would have like meetings about it and be like, I can't believe I'm talking about cannabis at work, and now it's like everybody's talking about cannabis. Some people are consuming cannabis, like it's just so much more out there. And I feel like people are a lot more vocal. And I feel that I myself have become more vocal about it in terms of, like, I think always around my friends and, my close family, they always knew my relationship, mostly because they also have a relationship with the plant. But I think even like colleagues and bosses, my daughter, I've become a lot more confident in how I talk to her about my relationship with it, which makes me very happy because I think, and something I talk to her about is generationally, my daughter's going to be 20 this year, and generationally, how I was raised talking about the plant was shrouded in shame and what it means about somebody that consumes cannabis. It's usually a negative connotation. And fighting through that for myself and how I look at myself and my relationship to consuming cannabis vis-a-vis how proud I am, or maybe proud is not the right word, but totally open to talking about it. I would say that is something that's probably changed the most and that I'm happiest about.
That's awesome. That is a great answer.
Yeah.
And then maybe one for the listeners that are looking for what to listen to next. What's your favorite episode from all the Seeking Alpha content?
I will tell that, but I'm interested to hear how your guys' relationship has changed since you started working in the industry, if you had a pre-existing one.
I would say since working in the industry, I would say in more recent years, I've definitely forced myself. I'm a bit of a creature of habit, and I love routine. So it's a little bit more difficult to go out and branch into new products and product categories. But I've forced myself to do that recently, just to understand how people, why people like certain products in certain ways. And so that's been one of the big items. Is I try not to like repeat purchases from a certain brand. Although I'm definitely, I will do that with, certain the growers that I like, especially if they're doing, drops a couple times a year. But, things like, branching across, first time trying live rosin a few months ago, or maybe, but whatever that was, entirely very similar product category within the cartridge, within cartridges, but then also the, terpene profile is so much better. The product is significantly better. And then doing that even across, edibles and kind of branching into other types of products like that. So I think, diversification has been a big change. And then, around my community, it's definitely been, I don't know if I could describe it any better than you did, Rena, but being more normalized around friends and family about it. It was definitely a huge shift coming from the wonderful world of finance into cannabis. And it's become significantly easier every single year. But I'd say those are probably the two main areas. Mike?
I'm not a huge consumer, and before this was, before sort of getting in the industry wasn't a huge one either. But I guess learning more about it and how it helps lots of people, and I guess just more learning all that it can potentially do. Like I said, the whole science aspect of what we're trying to figure out, but also just the more normalization. I've always tried to normalize it. I'm more of a live and let live, and I don't have to like something just to, I tweeted about this. I was like, I hate the smell. I was like, well, I hate the smell of tuna fish. I think tuna fish is like the most disgusting thing ever. But I'm not going to like put people in jail for eating tuna fish or like tax the deli. Like, you want tuna fish? Great, go for it. But it also means I can still analyze the tuna fish industry pretty easily because I understand how supply, demand, and margins and cyclicality and all that stuff works. But I guess my relationship with it is more, as we see more innovative form factors, I'm probably more the marginal, year 5 growth versus converting the existing user from the unlicensed market to the legal market. I'm probably more the, hey, I might actually try, a drink, like if, that sounds interesting, I might try that. Or I might, I'm probably more the one that would is more the second phase of growth of the increased consumption of the population. When things change, it becomes more just normalized and not stigmatized. And I'd like to think that also I'm helping others who are even more distant from it actually get more used to it. Like, yeah, it's just this normal thing. And you've mentioned your daughter, like my son's 12, and having a conversation about him. It's like, yes, this normal thing grown-ups can do if they want, right? Like, it's not this crazy thing. It's like, yeah, some people like it, some people don't. Colorado, it's about 19% of the population reportedly. So, and that seems to keep rising. So, make your own choices when you're a grown up. So that's sort of where I'm at. But I do think it's from my whole philosophy of personal choice and doing what you want to do, I'm 100% behind, fighting for the right for people to do what they want to do. Right. And if this is what they like doing, then they should have every right and legal protection to pursue what they want to pursue.
Amen.
So,
amen. I was going to say, with your son being 12, I was going to say generationally, he probably understands that already, but I was going to say growing up in Colorado, he probably really understands that. He's probably got.
That's the thing I point out, like I think Colorado is more like the laboratory of what the world could look like, of just, there's dispensaries stuck between the Home Depot and the Whole Foods. And then you go 4 blocks down, there's another dispensary. Like, I'm talking literally on Colorado Boulevard. You can go Google Maps this. There's another one across the street from the Mercedes dealership. You drive a little farther, there's another one, next door to the Qdoba. Like, it's just a normal thing. Like, it's not any different. There's nothing special. I was like, yeah, that's where you go if you want to buy that. You want to buy some nails, go to Home Depot. And I point out, like, it's even in the Val pack, those things like where you get like 50 coupons in the mail. I've been tracking those. It's like all the plumbers and, get your, house cleaners and get blue blinds. It's like, oh, and here's the Starbucks one, and here's the green solution one in the Val pack. It's like just totally.
That's awesome.
I don't need blinds this week. Oh, but I give you $25 off $100 at Green Solution. Okay.
That's awesome.
And this is what it is.
That's awesome. All right, I'll tell you my favorite episodes. I would say one of my all-time favorite interviews was from CEO Interviews, which is a video show on Seeking Alpha where they interview CEOs of companies. And Alan Natowski, I think is how it's pronounced, from the company called Funware, is just like one of the most interesting guys that you can talk to. They're doing interesting things at Funware. I like an unvarnished interview. I like people that are coming and willing to talk and, looking to have a conversation. And I just really feel like I learned a lot about kind of the blockchain space and creating a business within a business around that. And also just how kind of open he is with his opinions and sharing things. And I would say from the Cannabis podcast, Guy Rocourt was one of my more favorite recent episodes, just in terms of, he was coming from Papa and Barkley and just talking about the artisanry around cannabis and kind of keeping your soul in the industry. I found it very inspiring and moving and just from a business perspective, kind of like really trying to do something.
Awesome. Yeah, it was a great episode.
And this will be one of my new favorites because it's always fun talking to you guys.
Thanks so much for listening to the Cannabis Investing Podcast. Subscribe or follow us on Seeking Alpha, Libsyn, Apple Podcasts, Spotify, or Stitcher. And we'd really appreciate it if you left us a review on Apple Podcasts. It helps other investors find our show and makes us feel fantastic. If you have feedback or questions, we'd love to hear from you at RENA plus CANPOD at seekingalpha.com. That's RENA, the plus sign, CANPOD at seekingalpha.com. Nothing on this podcast should be taken as investment advice of any sort. I'm Long Trueleaf, Chiron, Isracan Biosciences, the parent company, Air Wellness, and the ETF MSOS. Subscribe to us on Libsyn, Apple Podcasts, Spotify, or Stitcher. Thanks so much for listening, and see you next time.